biggest risk to the United States economy isn't inflation. It's not a recession. It's not AI. It's not China. It's a number that Congress made up. A number that has no economic logic behind it. A number that the United States has raised 78 times since 1960. And every single time it approaches, the entire global financial system holds its breath. Because U.S. Treasury bonds are the backbone of global finance. They are the collateral behind trillions of dollars in loans. They are what central banks hold as their reserve asset. They are the foundation that the entire modern financial system is built on. And the debt ceiling is a self-imposed deadline that says, if Congress doesn't act in time, the United States will default on those bonds. Not because it ran out of money. Not because the economy collapsed. But because of a political argument. And here's what nobody tells you. The damage doesn't start when the U.S. defaults. The damage starts weeks before, when the clock runs out and nobody's sure if the deal is coming. That uncertainty alone is enough to crack something that was never designed to handle doubt. This is the story of the quiet bomb under the global financial system, and why every few years, someone lights the fuse. To understand why this matters, you need to go back to 1917. World War I is raging. The U.S. government needs to borrow enormous sums of money to fund the war effort. And up until that point, every single bond issuance had to be individually approved by Congress, which was slow, bureaucratic, inefficient. So Congress passed the Second Liberty Bond Act, a law that said, instead of approving every bond individually, we'll set a total ceiling on how much the government can borrow. It was designed to make government borrowing faster and more flexible. Why did the office worker bring a ladder to work? What it accidentally created was a political weapon.
Because they heard the markets were hitting the ceiling,
every time the debt
and they
approaches that
wanted
ceiling,
to get
which
a
it
better
always does
view.
because governments always spend,
Why did
Congress
the
has to vote to
investor
raise it.
bring a
And
ladder
that
to the
vote became
bank?
leverage, hostage, a moment
Because
where one
they
party
heard
could
the
threaten to
interest
let the
rates were
entire
going
financial
through the
system
roof.
detonate unless the other side agreed to their terms. For most of the 20th century, this was mostly procedural. Congress raised the ceiling. Government kept functioning. Nobody panicked. Then something changed. In 2011, for the first time in American history, the United States government came within days of a genuine default. Not because it was broke, because Congress couldn't agree. And for the first time, the world got a real look at what happens when the most important debtor on the planet plays chicken with its own credit rating. Standard & Poor's downgraded the U.S. credit rating from AAA to AA+. The first downgrade
Why did the
in
banker bring
American
a ladder
history.
to work?
Markets cratered,
Because he heard the
and a
interest
quiet
rates were going through
understanding
the roof.
settled over Wall Street. This is going to keep happening.
Why did the domino
This
bring
is
a
now
ladder
part
to the
of
bank?
the system.
Because
And
it
it
heard
did
the
keep
market was going to
happening.
take a big fall today.
2013, 2021, 2023. Each time, the same pattern. The clock runs down. Markets start to sweat. A deal gets done at the last possible second. Everyone exhales. But each time, the line gets a little closer to the edge. Here's what makes 2025 and beyond more dangerous than any previous debt ceiling standoff. The numbers are different now. When the U.S. hit its debt ceiling in 2011, total national debt was around $14 trillion. Today, it's over $36 trillion. The interest payments alone on that debt now exceed $1 trillion a year, more than the entire U.S. defense budget, which means the ceiling gets hit faster. The political fights get bigger, and the margin for error gets smaller every single cycle. But there's something else, something that doesn't make the headlines. In 2023, Fitch Ratings downgraded the United States from AAA to AA+. The second downgrade in American history. The official reason? Not the debt level. The deterioration of governance. The repeated last-minute debt ceiling standoffs. The growing evidence that the political system cannot reliably manage its own finances. And here's why that matters beyond the symbolism. An enormous number of institutional investors, pension funds, insurance companies, sovereign wealth funds, are required by their own rules to hold only AAA-rated assets. When the U.S. loses that rating permanently, those institutions have to start rethinking their Treasury allocations.